When we were looking at $1,200 or $1,500 gold, I don't think I know I didn't foresee this kind of an upward move. I don't know many that did. Those that did got it right. No, I'm absolutely amazed. If you look at the course of gold from even 2018, it tops out at 2000. It then goes back to 1600 in 2022. It's 2022 to now that is most impressive because a $1,600 move to 3,300. So in essence, a doubling of price occurred really, in just a short period of time, 3 years. So am I as enthusiastic that we'll see it go from 3,300 to 4,500? No. My year-end call right now is between $36 and $3,700 for gold. 36 more based on spot, and then futures closer to 37.
Gold was around $1,200 to $1,500 in 2018 and 2019, and a surge to $3,300 over just 3 years has been surprising. While a further jump to $4,500 seems unlikely, the speaker expects gold to end the year between $3,600 and $3,700, with spot prices closer to $3,600 and futures nearer $3,700. JP Morgan projects average $3,675 by Q4 2025, potentially crossing $4,000 per ounce by mid-2026. If recession concerns persist, the gold futures chart, August contract, which shows gold staying above its 50-day moving average, which signals a short-term bullish trend. Though it briefly dipped near that line in mid-May, it didn't close below it. Technical indicators, such as the Fibonacci retracement, suggest support levels at approximately $3,330 and significant support at $3,200. Gold also recently broke out of a compression triangle pattern. The move lacked the strong momentum usually expected. This suggests that, while the market remains bullish, enthusiasm has waned. Resistance levels are at $3,400 and $3,500. The outlook now depends less on technicals and more on fundamentals, especially trade negotiations with China, which remain uncertain as few agreements have been finalized. Instead of investing all at once, consider putting in a portion, like 25%, and use a dollar-cost averaging strategy to buy more if prices drop or rise. Gary still buys gold and silver in small amounts, even after earlier purchases at much lower prices. Precious metals remain valuable, especially when the US dollar is weak, which supports higher gold and silver prices regardless of tariffs or global tensions. Before diving in, don't forget to subscribe and hit the bell icon for timely updates.
We're looking at a daily chart, standard candlestick format of gold futures, continuous contract, now reflecting the August contract. And this green line here represents a 50-day moving average. 50-day moving average, simply put, it's a golden rule for us technical analysts. A stock or commodity above the 50-day moving average is in a bullish short-term trend. It's not sideways, it's bullish. Below it is bearish. And we use that, and we use for the longest term 200-day, and we use 100-day. But as you can see, at the beginning of January, gold broke back up above that, and from there it has maintained a status of being above the 50-day moving average really for the entire year. Now, the other thing you want to look at is how close or far it is. So immediately there was some real width between current pricing and the 50-day, with the pricing being well above that. If you look at right now, what we are seeing is that it is still above it, but it challenged it back in the middle of May, where you had some lows that broke below it, but not an open or closing price. So we're looking at that. The other thing is, this is a basic Fibonacci retracement. This line here with these two black, the bottom one is the lower level around 3,000 and then 3,500. And so what we're going to use that data for is really to discuss major and minor levels of support. And so major support corresponds to these lows mid-May, was the 61.8% Fibonacci retracement. So we had an absolute correction right here. After going parabolic, we would look at this is an A, B, C correction. So in Elliott wave count, we're back into a bullish momentum or a wave one. That tells you that all things being equal, if Elliott wave carries some real validity in it, we should see higher prices unless it breaks below certain things. The first level remains above the 50-day moving average, which is currently at 33, call it 3308, 3,305 to 3,310. As long as it remains above that price point on a technical level, it is still bullish. So that is my assessment for gold. In terms of upside targets, 3,440 is resistance, and of course 3,500 absolute major resistance. Support begins at 3,300 3,100 and with major support, believe it or not, down at around 3,200 because we've seen this. It was a $500 range in April the 21st, so in about under 3 weeks. And so that's what we want to see. And that is not going to be contingent on technicals. That's going to be contingent on fundamental events as they work through the cycle. And a lot of it has to do with the trade negotiations because Trump has already stated he's doing tariffs. He wants to kind of even the playing field. Now, what are the trade agreements that will be reached? Because from my understanding, very few have been inked. And that's where we're going to see something happen. You'd want to be very, very cautious. And if your allocation, let's say, is, we'll call it 1 point, the $100, just so we can break it down, right? You don't want to put that $100 into buying gold. You might want to put 25 so that you can dollar cost average if it does come down. You can dollar cost average if it moves up. And of course, you would have been better off putting the bulk, buying it now. So my simple answer is, should they buy it? Yes, but they should buy it with much more caution and a layered or scaling in or out plan rather than just allocate. But by all means, I mean, the last bulk of gold that I bought was at about 1,500 an ounce, but I'm still looking at buying incremental amounts. The same thing with silver. I was buying a lot of it at $30 and I kind of forgot about it. Now it's at 36, so I'm trying to see where it's going to go. Don't ever count the precious metals out, regardless of tariffs, regardless of geopolitical considerations. As long as the dollar remains weak and has the potential to move lower, gold and silver will move higher. And that's the key right now.
Gold has strong support, around $3,200. If it drops below that, especially under $3,100, it could signal a shift from a bullish to a bearish market. This has happened before, like in 2011. When gold crashed from record highs and entered a years-long downtrend. Since gold has risen quickly from $2,600 to $3,300 in just half a year, a correction of $300 to $700 is possible. However, such a drop wouldn't be triggered by technical levels alone, but by significant shifts in fundamentals, such as a stronger dollar, resolved trade tensions, lower inflation, or changes in the Fed's interest rate policy. Silver briefly reached $37. Similar to gold, which hit an all-time high of $3,500. For silver to keep rising, it needs to sustain trading above $37. If it does, there is little resistance until $42, with an extreme upside around $47.50, although that's unlikely. While gold saw substantial gains from both dollar weakness and trader activity, silver mainly benefited from the weaker dollar. On the downside, key support levels are around $33.80 and $31. If prices fall, watch how they react at those points. Expect high volatility at these levels, so short-term trades require flexible strategies. Tight stop losses may not be effective.
Major support's at around 3,200. It's at 3,340. A break below that, first break below the 50-day moving average, it would break through recent lows. The lowest low that we had after the big clip from 3,000 to 3,500, it went to 3,123. Break below 3,100, and that could easily signal that we have moved from a bullish market that slowed down to the beginning of a bear market, because obviously at some point, gold will react the other way. We saw that in 2011 to the middle of 2011, where we saw it run up tremendously, 1,000 up to the all-time record high, then just above 1,900. And just as everyone thought, 1,900, 2,000 is the next move, it began to sell off. And first it went between 1,800 and 1,900. Then it broke to 1,535. And once it broke below that, we had a multi-5-year deep correction in gold, not finding support till $1,000 per ounce. And that was in February 2015. So could it go lower? Yeah, absolutely. I've seen it happen before when I didn't expect it. Fool me once, that potential not only is possible, I believe at some point we will see gold have a realistic size. What that means is that as fast and as high as it's moved up, where it's in essence doubled from the beginning of the year. If we take a look at what prices were in 20, it was $2,600 at the beginning of this year. Half year later, get rid of it completely because it's a very long-term investment for me. In fact, it's not even an investment for me. That's put away for the kids. And I think that 10 years from now, that it will be much higher. But short term, if I'm a futures trader, I'm going to focus on Whether or not this is sustainable, if it's not, I'll look to sell into it. That's a little bit too easy because it hasn't proven that it's not going to move higher, except for the fact that it got there and for a very short term, for a couple of days, it's traded below it. I don't know that the cards are written that 37 is the top. It is a point where the institutional and professional traders would look to sell into it, but then you would have a chance to buy that dip and have it break back above it. I don't think the story is over. On the upside is almost 42. This is basis of futures contract between $41 and $42, with the absolute upside being about 47.50, which I don't see as realistic because then you're looking at the record levels, the highest silver's ever been. But what has been the most incongruous fact that we've been looking at is the fact that gold has made multiple all-time record highs. A lot of it had to do with the fact that the dollar went down 10% this year. But if gold went up 25%, 15% was due to traders and 10% was due to dollar weakness. Silver, we didn't see that. We got the boost up from dollar weakness, but not from traders. So, on the downside, the targets I would look at in terms of support would be about 33.80. If it does come down, I would look to see whether or not it can hold that level. Absolute support is got to be above $31 right now. Realize it's near 37, but those are big areas just because of the way that it has risen. The second thing I would say is whether it goes up from here or down, you're going to get extreme volatility at these new levels. Absolutely. So tight stops aren't going to work. You're going to have an interim strategy to successfully trade silver, not buy and hold.
Gold's rise from $1,200 to $1,500 to over $3,300 in just a few years has been impressive, but further upside may be limited, while the long-term outlook remains cautiously bullish, with forecasts of $3,600 to $3,700 by year-end and potentially up to $4,000 in recessionary conditions. Current momentum has softened. Technical support of around $3,200 is crucial, and fundamentals such as inflation, Fed policy, and global trade will shape gold's next move. For new investors, a gradual approach using dollar-cost averaging is advised. Silver also shows potential, especially if it holds above $37. However, both metals are entering high volatility zones that require adaptive trading strategies. What would be the most significant fundamental trigger for gold to break above $3,700 and stay there? How should a new investor adjust their gold allocation strategy if support at $3,200 is not met? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos.